All right, so this is the first section of the pretty good size unit that we're going to be dealing with, having to do with income taxes. Uh, we're going to end up talking a lot about income taxes and the way that we can adjust income taxes and all that stuff, the adjustments, the deductions, the tax rates, things like that. The first thing we're going to do is we're going to actually talk about the adjusted gross income. In the United States, citizens must file their taxes by April 15th each year. Taxpayers search for deductions and credits that can help them save money. Taxpayers collect their W-2 form, complete federal tax forms, calculate numbers to determine whether money is owed to the IRS. Some may owe money, while others may be owed a refund. Tax season can be a stressful time for individuals. Many forms and documents are required. Some choose to complete their own tax filings on their own tax software or old school with forms, and others choose to hire a company or an accountant to complete their tax filings. The Internal Revenue Service, or the IRS, is the government agency in the United States that is responsible for tax collection and tax law enforcement. The IRS publishes tax forms and instructions online for people in order for them to complete their taxes yearly. On its website, IRS provides help and guidance to taxpayers. The IRS is also in charge of tax law enforcement, therefore it is important to file personal income taxes correctly and on time. In case the IRS should ever review or audit accounts in the future, it's wise to keep all tax information and records in a safe place for up to 3 years. This will provide proof of taxes and assets to show the auditor. The tax process is not only applied on April 15th, it's an ongoing process. When a new job begins, a W-4 form is completed. This form includes personal information used to determine the taxes that will be taken out of each paycheck. When tax seasons arrive, employers send out a W-2 form, which includes the total wages earned, how much they paid you, the amount of federal taxes that were withheld, and the amount withheld for Social Security tax, Medicare, state taxes, etc., all the things that they pulled out. The W-2 form will be received from employers no later than January 31st for the current tax season. Below is an example of a blank W-2 form. So of course it would have the employer's identification number, their name and address, your name and address, and all that stuff, your Social Security number, and here's wages, tips, and other compensation. This is your pay, how much income tax for the federal was withheld, Social Security. This is the amount of wages that Social Security is calculated on. It may be different from that sometimes. Then this will be the Social Security tax that's withheld, how much they pulled out for Social Security, otherwise known as FICA. Medicare tax withheld, Social Security tips. Typically those are not going to be filled in. And then never seen that one filled in on any of mine, but you may. And then different things on there that may affect you a little bit. Now, along with the W-2 form, individuals may also receive a 1099 form. A 1099 form reports miscellaneous earnings such as self-employment wages, interest, dividends, and other forms of income. Now the 1099 is going to have a dash, and then it'll have other things on it. It might have MISC, that's miscellaneous. .-I is interest typically. There's a bunch of 1099 forms, and they typically are specifically for whatever they're being used for to report. Now, to calculate the personal income tax, the adjusted gross income must be known. The adjusted gross income is the gross income minus specific deductions. To find the adjusted gross income, find the sum of the total wages, dividends, capital gains, unemployment compensation, and tips, and then subtract certain adjustments such as contributions to a retirement account or alimony payments. You do not have to pay taxes on those. That's why you can deduct them from your gross income. So example 1, Amanda earned $35,769.08 in wages last year. and $1,460.43 in interest income. She contributed $3,500 to an IRA. Find her adjusted gross income. So all you're going to do, income, she earned in wages and this in interest, so you would add these together. That's her total income for the year. And then to find the adjusted gross income, you're going to subtract her contribution to an IRA, because that's a deferred tax retirement account. So that means you're not paying taxes on it now, you'll pay taxes on it after you retire, when you draw money out of it. So you do the $35,000 plus the $1,460 minus the $3,500, so her adjusted gross income is $33,729.51. All right, so all you're doing really here, and I'll walk through these, but all you're doing is adding up all the income, subtracting any contributions. So Alex earned $56,199.01 in wages, this much in interest income, and he earned this much in miscellaneous income, maybe side jobs, things like that. So he adds all those up, that's his total income, and then he contributed $5,000 to a retirement account, so he's going to take that and subtract it. So here we got that, and that's his adjusted gross income. All right, Warren earned $78,000 in wages and $2,540 in interest. He contributed $7,500 to an IRA, so we'll put all that together. Add income, subtract contributions, and there's his adjusted gross income of $73,192.76. All right, so this one's a little more complicated because you actually have to calculate how much she earned. Grace is an hourly employee. She earns $11.50 per hour, worth a total of 2,080 hours during the year. So 2,080 times 11.50, that's going to give you the total amount of compensation that they paid her. In other words, how much all her gross paychecks were. She has no other form of income. However, she contributed $1,200 to an IRA and has $750 in alimony payments. So those are two things that we're going to subtract away from what she earned. So $11.50 times 2,080 gives us $23,920. That's how much her gross earnings were. Then we subtract her IRA contribution and her alimony payments, and we get a gross income, adjusted gross income of $21,970. All right, same thing here with Elizabeth, except she's got a monthly salary, so if we know, we got to calculate the entire year. So Elizabeth receives a monthly salary of $3,250. She also received $2,300 in interest payments for the year, interest income for the year. She made an IRA contribution, which resulted in an adjusted gross income of $36,300. So you're kind of working backwards here. You're trying to find out how much she contributed to her IRA. So first thing you got to do is you got to find the yearly gross income. So $3,250 a month times 12 for the number of months gives you $39,000. And then she had the $2,300 in interest payments, so those two add up. And then if she add the $39,000, the $2,300, and then you subtract the IRA payment, the IRA contribution, you're supposed to get an adjusted gross income of $36,300. So now all you have to do is just work backwards, and if you subtract the $39,000 and the $2,300 from this side over here, you're going to get a negative number, but this is a negative IRA contribution. Think of it as a variable. And then when you go to solve that, you're going to end up with negative IRA equals negative 5,000. So you divide by -1. So her IRA contribution was $5,000. Remember, all this is just algebra if you don't know something. If you don't know something, put it in the equation like you normally would, work backwards and solve for it. All right, that's the first part. And this is the first part where we're worried about getting the amount of money we're paying to taxes down a little bit and just finding that adjusted gross income. We'll have other deductions and things like that that we'll talk about later in the unit.